It is Wednesday, July 5th, 2017. It is 8 p.m. Pacific Standard Time. So you know what time it is. It's time for some coin metal. And it was not a terribly productive get your ass kicked at Jiu-Jitsu Wednesday. As a matter of fact, I did not spend a whole lot of time getting my ass kicked, only because I am still trying to recover from an injury. And actually, and for those of you who are familiar with Jiu-Jitsu, know that injuries just come with the territory. You know, it's not ballet. You know, they call it the gentle art, but it can get brutal. It can get downright brutal. Anyway, with regard to today's material, I have various tabs open on the browser with no particular direction. Twitter, always is in the background, and so we have that to depend on for the moment, at least, until some hacker or some government agency pretending to be hackers, or I don't know, somebody like that hacks Twitter and fucks everything up, and I don't know. I don't think there's a very high likelihood of that happening. I think it's probably more likely that Twitter will simply fall out of use, as the way that MySpace had, and how I expect Facebook to sometime in the near future. Although their decline, I think, will be a lot more harsh than others, because they're like one of the top valued companies in the world, which I find very, very surprising. I mean, kind of surprising, but then again, kind of not. I mean, if you've been a Facebook user for any duration of time, you've recognized the expansion of services and apps and whatnot that have kind of weaned their way into Facebook and making it more usable for the user. But as we've covered on this show before, that's not entirely unique anymore, and it seems like that Chinese ideology of just copy the guy that's doing the new shiny and do it better and faster than him. That seems to be pervading the majority of technology these days, not just in China. But with regard to that, I was kind of wool gathering there about the repetitious cycle of scammery within the cryptosphere that I've observed. You know, we had the first initial boost of altcoins, and then we had kind of a small crisis of a proliferation of altcoins. And suddenly the dilution was so much so much that we're looking at it and going, you know, what exactly is valuable out there? You know, which one of these coins should I bother putting any hashing power to, or should I just stick to Bitcoin? You know, and beat my head against the wall as I compete against ASIC miners. And to some extent, I think we rinsed through, like, within the first year or two, by like 2015, 2016, the altcoin market kind of started, I would say late 2014, early 2015, that a lot of the alts that had started during the previous period and just got completely fucking hyper diluted, the ones that nobody was really interested in the project or whatever, for whatever reason, their community cheesed out, their fucking dev bailed to Costa Rica or some shit like that. But for whatever reason, a big chunk of altcoins fell off, and some of them are there's a good deal of them that are still out there and live, but a lot of them did fall off. And we did notice a spat of people claiming to have commodity-backed cryptocurrencies, and those are always really entertaining. And if you look back to my YouTube channel, I've got the show up there, commodity-backed commodity-backed coins / tokens, the triple layer mystery cake of crypto. Yeah, that's pretty much what they are, and it doesn't get any better when you're talking about things like Ethereum tokens or things like that. It's, it's tokens all the way down. Yeah. We've heard that song before. But anyway, that's actually like the second iteration of this phenomenon. It's like it expressed itself first in altcoins, and now it's expressing itself in ICOs. And it's funny because at least during the altcoin phase, or craze rather, a lot of people actually had code, or a lot more people had code than do in the ICO space apparently. But that's neither here nor there. The idea though, the attempt rather to use something that appears to be semi-legitimate to scam people out of money. That, like I said, it's a cyclical thing. I mean, in crypto, there's some level of it constantly, and we like it that way. It's just fine. After a while, everybody who could get burned does get burned, and everybody else figures out to avoid the shit, and then their new users dry up and they go away and they die off. That's the way these things are supposed to happen. But Craig writes, I listened to his talk the other day, and he said some really interesting things. You know what? Before we get too deep into that, I do want to go ahead and get in our first dance. And of course, I haven't picked anything out. I just started freeballing it. I guess I have a little more energy in me today because it wasn't beating the hell out of me on the mat. But anyway, let's go ahead and throw in some textures here. Regenesis here on Coin Metal. And that was Static X with Machine. Ah. Man, I love that song. Anywho, I haven't picked much of anything specific to go on today. I haven't noticed too much that's been strange or aberrant or aberrant. Is that the right word for that? Not abhorrent. I don't know, it seems like it all kind of blends together after a while, that it's all starting to look the same. It's like, oh, ho-hum, there's another scam over here, ho-hum, there's another new altcoin over there, ho-hum, there's another argument in the debate between scaling or not, or whatever. Oh, Craig Wright. That's where I wanted to go. I was talking about before the music break about how I had listened to his little spat, his little diatribe, and I found it interesting, to be sure. And he did say some stuff that I did agree with, but then he said some other stuff that made it pretty clear to me that he's not Satoshi Nakamoto. Or at least I don't think he's Satoshi Nakamoto. I don't really care if he's Satoshi Nakamoto, because what he was saying, some of it, I like I said, I really agreed with, such as the idea that segregated witness is a boondoggle. I don't think it's the right way to go with Bitcoin. However, he did seem to glom onto this very, how should I say it, almost materialistic ethos with regard to Bitcoin. Is very hyper capitalistic. It's like he said something about if you can't afford a $20,000 machine to mine, fuck you. And if you've been in crypto all this time and you can't afford a $20,000 machine, fuck you. And It's like, dude, what the fuck are you trying to get people to not try and get into Bitcoin? I mean, is that what you're trying to say to us? But he did say something about, with regard to scaling and optimization of the algorithm and whatnot, and I did agree with that. But I still believe that the best way for Bitcoin to go forward is for there to be a greater array of miners out there, both hardware-wise and software-wise. I think that this latest little blip, there is something that I am very excited about with regard to crypto, and it's the fact that AMD and Nvidia are finally getting into the mining game. That they're going to be making cards specifically for mining cryptocurrencies. That way they have video cards for the gamers, because otherwise everybody's trying to mine with their fucking video card instead of play video games. Anyway, I think that's a really cool development. I think that should have happened about 2 years ago, and I'm really glad to see that kind of movement happening. I think that they're going to find very, very quickly that there is a demand for such a thing, especially if their hardware works as good as their video cards do for the process of mining. But anyway, back to Craig Wright. He was talking about bigger blocks and scaling on chain as opposed to doing off chain solutions like segregated witness and lightning nodes and all that business. And I happen to agree with that perspective. That's been my perspective this whole time. I mean, the network seems to run relatively well as is. It certainly could operate a little better, but I think that a lot of the issues that we were suffering were more or less manufactured in conjunction with other attempts to push a specific scaling idea, and that would be segregated witness. But so far, it seems segregated witness has not gone through, and I'm still hoping it doesn't. If there is a fork, there's a fork. I think it'll last all of like a week, and then it'll crash, and then the Bitcoin chain that has the most miners on it will prevail, and everything will go forward just fine without segregated witness. But that's me. That's my optimism. I just don't think there's going to be a density of miners that is big enough to keep the segregated witness chain going, or to stay ahead of the rest of the network. Anyway, we've seen how that all that shit goes down. We watched it happen with Ethereum, and I don't see why people can't look back and take a good look at that and see why it happened, and realize that they're trying to do the same thing to Bitcoin. They're trying to. There's a group of people that aren't about choice, and they want to impose their will on the rest of everybody else, and they really don't care what anybody else has to say about it. It's like I was reading one of these Reddit articles about something in Bitcoin, and somebody had the audacity to call miners ignorant and stupid because they didn't want to use segregated witness. And I'm thinking to myself, I'm like, okay, this is obviously somebody who doesn't mine, so they should just shut the fuck up. Because the fact of the matter is, they're not dedicating tons of money at hardware or electricity, and their business model doesn't revolve around keeping uptime 24/7. And so they don't have the right the right, mental context for understanding what it is to be a miner. And they're taking for granted exactly what the miners do for the network. They are the network. Now, I have heard some people claim that miners aren't really all that important. And I find that really funny, because the people that say this seem to believe that nodes that are sponsored by, quote, users or, quote, the community, they seem to think that those are the ones that determine what protocols are running all that other business. No, they don't. They just determine which blocks they're going to accept. And if they're geared to accept segregated witness blocks and not legacy blocks, they're probably going to be in a very, very tiny minority of the network. So, I mean, it's like, why would you even bother? Anyway, enough about that business. It's either going to happen. It's either going to happen or not happen, and I don't think it's going to happen. But if it does happen, we'll live with it. Anyway, let's go ahead and get back and do some articles here. I did have one here, and I think it's kind of a misread, because regulations occurring in any one space, they may have implications elsewhere, but they'll in the grander scheme of things, if there's an intent party, they will circumvent regulators. That's all there is to it. They will find a way to do what they intended to do without anybody knowing, without anybody being able to tax it. That's just what these currencies enable to do. And to that point, that's not even something new. You can already do that with physical cash, something that governments seem to be in a big old hurry to get rid of. But anyway, this article here is on CoinDesk, and it's Nail in the Coffin: the day U.S. regulators stifled Bitcoin startups. This was written on July 4th at 10, doesn't say AM or PM, by Jerome Lukasiewicz. I don't know. I'm not going to spend all day on it. Anyway, apparently he's got a penis. And let's see, here we go. Reflecting on this piece, wait a minute. Where exactly does this fucking thing start? Okay. Because it's got a little bit of a preface here. Alright. Reflecting on this piece, I feel like part of an older generation of Bitcoin, even though when I entered the space in 2012, my impression was that I was late to the game. Many crypto enthusiasts had already been active in it for years, mining away, and I still had much to learn about the blockchain. It's interesting to look back now. Since 2012, I was entering an industry that was completely unregulated and still in its Wild West infancy. Most Bitcoin exchanges were sketchy, and I set out to build a reliable US-based exchange called CoinSetter, since acquired by Kraken, which I highly recommend. In that process, I witnessed the emergence of new regulation that would impact the entire industry. 18th March 2013 was the day the U.S. federal government came out with regulatory guidance that marked most Bitcoin companies as money service businesses. Being the optimist that I am, I viewed this announcement as a positive development, an opportunity to legitimize our company and the broader Bitcoin industry. In hindsight, The policy would become the slow nail in the coffin that would prevent Bitcoin from disrupting consumer payments en masse. With 50-plus new regulators to report to, compliance became a concern for most companies. Know Your Customer rules were just the beginning of compliance and, frankly, the easy part. Regulation became much more challenging in the areas of licensing, impossible to obtain, transaction monitoring, impossible to comply with the status quo requirements, banking relationships, impossible to maintain, reporting, and capital requirements. In March 2013, most of the industry's leaders had little understanding of these topics. After Bitcoin companies hired lawyers, consultants, dedicated countless hours to completing paperwork, and spent lots of money, most regulators did the following. Number 1, pushed off taking action, leaving companies in a legal gray area. Or number 2, closed bank accounts, thereby cutting companies off from the global banking system. My experience with the, quote, BIT license was a direct example of this behavior. New York introduced a framework for Bitcoin companies to apply for regulatory licensing and thus obtain a path towards operating with legal clarity. The BIT license formation process took years and was ultimately a way for the state regulator, Ben Losky, to attract positive press for himself. He left shortly after BIT license applications were due and didn't stay to approve any of them. Only a few companies ever received licenses, and most applications are still in limbo years later. It's frankly stressful running a Bitcoin or blockchain company in the U.S. For our team at CoinSetter, even when we reached out proactively, most regulators politely denied us a path toward full compliance. Living in an undefined regulatory environment, we always had the dangling fear that we could be penalized at any regulator's sole discretion. You didn't have to be doing anything wrong to feel that way either. Has the regulatory situation improved? In some areas, yes, but the banking issues Bitfinex and other exchanges experienced recently are a lingering direct consequence of these policy decisions made 4 years ago. Today, the challenges Bitcoin companies previously faced are hitting blockchain projects. It's unfortunate since these organizations are building the modernized infrastructure that will create a more secure digital future for everyone in the world. I believe they'll succeed, but anyone starting these companies will have to deal with similar regulatory uncertainties like Bitcoin faced a few years ago. I hope companies will take a strong public stance against stifling regulation as it comes up. For those in the U.S., it is important to remind regulators that technology companies are going overseas because of the current regulatory environment. Billions will be invested in blockchain startups. Will the U.S. choose to benefit from it? But to me, 18th March was the start of it all. It drastically changed how Bitcoin and blockchain companies would need to operate going forward within a regulator-influenced paradigm. The industry hasn't been the same since. And I kind of agree with them. I will say this, that whatever regulatory bullshit this started, there's plenty of people that aren't bothering to adhere to it or even bother to ask for permission. Interesting. This is the Financial Crimes Enforcement Network. You know, what really bugs me about all this shit is that cryptocurrencies, one of the things that we have to rely on in lieu of any kind of regulation, I wouldn't call it trust so much as reputation. You know, if you are fucking up, like apparently Yobit, well, I'll just use them as an example. I hear the most complaints about Yobit out of all of the exchanges, and there have been others in this class. You know, I think like CoinMX was another one that people just bitched the hell out of that thing while it was going, and then it turned out to not be working, and you know how that one went. But the point being is, regulators and licenses and whatnot are supposed to impose some sort of trust, or at least infer some sort of trust that, you know, you're not conducting illegal activity because this person has a fucking license. And give me a fucking break. You know what? As far as the global economy is concerned, we're trading Pokemon cards. There's certain countries out there that have started to take this a little more seriously than Pokemon cards, but really that's how they should regard it. They should regard cryptocurrencies as none of their fucking business. No more of their business than trading Pokemon cards. Because the fact of the matter is that trying to squeeze us even at this point would be incredibly damaging to the future of whatever country does it. It's one of the reasons why China and Russia haven't gotten as stringent as they would really like to with regard to cryptocurrency regulation. And it seems like Japan is even been letting up a little bit further than most. And, you know, with regard to their taxation of purchases of Bitcoin, and I think even the UK or somebody else was doing that before, where they were, I'm pretty sure it was the UK, where they were taxing Bitcoin purchases with some value-added tax bullshit, and then they figured out that was a stupid idea and they stopped doing it. But I've addressed this before, where I got an episode up on my YouTube channel about all of this regulation bullshit, and I really do view it as the mutually assured destruction pact of our time. That any country that gets really aggressive with regard to taxing or otherwise regulating cryptocurrencies will immediately start to fall behind everybody else that isn't doing it. And so, I mean, like New York, I would put them below like the Philippines or South Korea with regard to Bitcoin development, because there might be more money being dedicated to it in New York, but there's more brain power and more human hours being dedicated to it in South Korea. You know, they don't have as much money, but they got the fucking brain power, and they are applying it. You know, and I see that is going to be the future of cryptocurrencies at this current rate with regard to regulations. Is as long as we're having these bouts of, you know, claiming who gets to regulate cryptocurrencies and cryptocurrency business and whatnot, as long as we have that shit, we're going to continue to see this migration of cryptocurrencies and cryptocurrency companies over to countries that don't have that kind of regulation, and places where they really couldn't apply that regulation anyway, you know, like the darknet, or what else do they call that? The I don't know, they call it a couple different things, but anyway, point being that, and I've said this for a long time now, that I expect that cryptocurrencies will exist somewhere, just like they did back in 2013, which, with regard to the amount of regulatory overburden that they're suffering. And they might just end up pushing all the legitimate commerce straight over to the fucking dark web, you know? And I wouldn't be surprised in the least. You know, it's like they got all stringent with regard to file sharing. And what happened? Did file sharing stop? Fuck no. There's probably more sites now for you to go and download content that you really shouldn't have any access to. You know, movies that are still in the fucking movie theater, or albums that haven't been released yet, or, you know, shit like that. That's more available now than it's ever been. And I expect that trend to continue the more companies try and squelch it. You know, I haven't heard about any recent upgrades with regard to digital audio files or movie files in a little while. It seemed like there was a period of time where Sony kept changing their codec on DVDs to keep people from ripping them, and they'd end up getting cracked. I think one of them it got cracked before it was like fully released, or while it was still in beta, or some bullshit like that. Like, or they released it and it was like less than a week later, somebody had posted the source code for it and they were able to get around it. And so it became really obvious to them, I'm sure, that continuing to do this shit, it's not going to do them any good. They're just wasting money, basically. They might be making better video codecs in the process, but they're not really achieving the purpose of doing that, which would be to negate piracy. If in fact that's what it is. I don't consider it to be that, but who am I, right? Anywho, so yeah, regulation, and I suppose I could read the guidance here for FinCEN. That seems appropriate given the article that we read, because that's where we got this link. And you know what? I do want to go ahead and have a little short music break here, and then we will, on the other side of that, dive into this Department of Treasury Financial Crimes Enforcement Network. And I think that it's kind of timely to jump into this. Although, you know, honestly, it looks like this thing was put forward before I was even doing this show, so I might not have even ever read this thing. But anyway, like I said, we'll get on the other side of a music break. And what to play? I haven't quite picked anything yet. And of course, this thing is jumping all around, so I gotta wonder if all of these are actually the files that they say they are. So now we're down into Meshuggah, and I'm feeling Meshuggah. You know, I think it's appropriate, and I want to go something like earlier. You know, something off of Contradictions Collapsed. It's been a while since I've played anything off of it. But the right song, that's always a good question. Let's go ahead and go with Ritual off of Contradictions Collapsed by Meshuggah here on Coin Metal. And that was Pantera with Cowboys from Hell. Anywho, as promised, we are going to digest the Department of Treasury Financial Crimes Enforcement Network Guidance, Fin 2013 G001. Probably like their first paper, I would guess. Get a little bit of mood music going on in the background. It's a relatively short paper. It's only 6 pages, and I'm assuming there's probably not going to be a lot of diagrams and whatnot because it is a government work and they just like to fill things in with more words. Anyway, here we go. The Financial Crimes Enforcement Network, FinCEN, is issuing this interpretive guidance to clarify the applicability of the regulations implementing the Bank Secrecy Act (BSA) to persons creating, obtaining, distributing, exchanging, accepting, or transmitting virtual currencies. Some persons are referred to in this guidance as, quote, users, quote, administrators, and, quote, exchangers, all as defined below. A user of virtual currency is not an MSB under FinCEN's regulations, and therefore is not subject to MSB regulation, reporting, and record-keeping regulations. However, an administrator or exchanger is an MSB under FinCEN's regulations, specifically a money transmitter, unless a limitation or an exemption from the definition applies to the person. An administrator or exchanger is not a provider or seller of prepaid access or a dealer in foreign exchange under FinCEN's regulations. Currency versus virtual currency. FinCEN's regulations define currency, also referred to as, quote, real currency, as, quote, the coin and paper money of the United States or of any other country that, 1, is designated as legal tender, and that 2, circulates, and 3, is customarily used and accepted as a medium of exchange in the country of issuance. In contrast to real currency, quote, virtual currency is a medium of exchange that operates like a currency in some environments, but does not have all the attributes of real currency. In particular, virtual currency does not have legal tender status in any jurisdiction. The guidance addresses, quote, convertible virtual currency. This type of virtual currency either has an equivalent value in real currency or acts as a substitute for real currency. And there's some little sidelines here on the bottom here. Number 1, FinCEN is issuing this guidance under its authority to administer the Bank Secrecy Act. See Treasury Order 180-01, March 24th, 2003. This guidance explains only how FinCEN characterizes certain activities involving virtual currencies under the Bank Secrecy Act and FinCEN regulations. It should not be interpreted as a statement by FinCEN about the extent to which those activities comport with other federal or state statutes, rules, regulations, or orders. Number 2, FinCEN's regulations define, quote, person as a, quote, individual, a corporation, a partnership, a trust, or estate, a joint stock company, an association, a syndicate, joint venture, or other unincorporated organization or group, an Indian tribe, and as that term is defined in the Indian Gaming Regulatory Act, and all entities cognizable as legal personalities. Interesting. And then there's a bunch of mumbo jumbo here I'm not going to read. Background. On July 21st, 2011, FinCEN published a final rule amending definitions and other regulations relating to money service businesses, MSBs. Among other things, the MSB rule amends the definitions of dealers in foreign exchange, formerly referred to as, quote, currency dealers and exchangers, and money transmitters. On July 29, 2011, FinCEN published a final rule on definitions and other regulations relating to prepaid access, the, quote, prepaid access rule. This guidance explains the regulatory treatment under these definitions of persons engaged in virtual currency transactions. Definitions of user, exchanger, and administrator. This guidance refers to the participants in generic virtual currency arrangements using the terms, quote, user, quote, exchanger, and, quote, administrator. A user is a person that obtains virtual currency to purchase goods or services. And that's like given a little mark there for 7. An exchanger is a person engaged as a business in the exchange of virtual currency for real currency, funds, or other virtual currency. An administrator is a person engaged as a business in issuing, putting into circulation, a virtual currency and who has the authority to redeem, to withdraw from circulation, such virtual currency. Users of virtual currency. A user who obtains convertible virtual currency and uses it to purchase real or virtual goods or services is not an MSB under FinCEN's regulation. Such activity in and of itself does not fit with the definition of money transmission services and therefore is not subject to FinCEN's registration, reporting, and record-keeping regulations for MSBs. Administrators and exchangers of virtual currency. An administrator or exchanger that 1. Accepts and transmits a convertible virtual currency, or 2. Buys or sells convertible virtual currency for any reason is a money transmitter under FinCEN's regulations, unless a limitation to or exemption from the definition applies to the person. FinCEN's regulations define the term money transmitter as a person that provides money transmission services or any other person engaged in the transfer of funds. The term money transmission services means the acceptance of currency, funds, or other value that substitutes for currency from one person and the transmission of currency, funds, or other value that substitutes for currency to another location or person by any means. And I'd like to point out at this point that that's the thing that I keep stumbling on with regard to Lightning Network. If you're a Lightning node on a Lightning node network, on a payment network or whatever, you fall under this definition. And if you don't think you do, you need to read the white paper for Lightning networks, because you would be the person that transmits the currency from one person to another person, or because you're the intermediary there. Miners don't count under that because they don't actually differentiate the they don't pardon me, they don't take actual custody of other people's funds. But as a Lightning on the Lightning node networks, on the payment channels, you are taking custody of it. So, and you're responsible for the transmission of the data from your payment channel at the end of it. If when you are using one that's say 1,000 blocks long, run up to 1,000 blocks, you touch back down to the Bitcoin blockchain, you transmit. You are participating in the transmission of that. You are a money transmitter. That's why I think that segregated witness and Lightning networks are not a good idea, because it hard bakes into Bitcoin this requirement. And I think eventually it'll crowd most average people out of the ability to mine intrinsically. Anyway, continuing with this paper here, because we're on 3 of 6. It's going pretty quick. I like it. Administrators and exchangers of virtual currency. An administrator or exchanger that 1. Accepts and transmits a convertible virtual currency, or 2. Buys or sells convertible virtual currency for any reason is a money transmitter under FinCEN's regulation unless a limitation to or exemption from the definition applies to the person. FinCEN's regulations define the term money transmitter as a person that provides money transmission services or any other person engaged in the transfer of funds. The term money transmission service means the acceptance of currency, funds, or other value that substitutes for currency from one person, and the transmission of currency, funds, or other value that substitutes for currency to another location or person by any means. And it'd really help if they used some fucking commas in that. The definition of a money transmitter does not differentiate between real currencies and convertible virtual currencies. Accepting and transmitting anything of value that substitutes for currency makes a person a money transmitter under the regulations implementing the BSA. FinCEN has reviewed different activities involving virtual currency and has made determinations regarding the appropriate regulatory treatment of administrators and exchangers under 3 scenarios: brokers and dealers of e-currencies and e-precious metals, centralized convertible virtual currencies, and decentralized convertible virtual currencies. A. E-currencies and e-precious metals. The first type of activity that involves electronic trading in e-currencies or e-precious metals. In 2008, FinCEN issued guidance stating that as long as a broker or dealer in real currency or other commodities accepts and transmits funds solely for the purpose of effecting a bona fide purchase or sale of the real currency or other commodities for or with a customer, such person is not acting as a money transmitter under the regulations. However, if the broker or dealer transfers funds between a customer and a third party that is not part of the currency or commodity transaction, such transmission of funds is no longer a fundamental element of the actual transaction necessary to execute the contract for the purchase or sale of the currency or other commodity. This scenario is therefore money transmission. Examples include, in part, 1. The transfer of funds between a customer and a third party by permitting a third party to fund a customer's account. Number 2. The transfer of value from a customer's currency or commodity position to the account of another customer. Or number 3. The closing out of a customer's currency or commodity position with a transfer of proceeds to a third party. Since the definition of a money transmitter does not differentiate between real currencies and convertible virtual currencies, the same rules apply to brokers and dealers of e-currency and e-precious metals. B. Centralized virtual currencies. The second type of activity involves a convertible virtual currency that has a centralized repository. The administrator of that repository will be a money transmitter to the extent that it allows transfers of value between persons or from one location to another. This conclusion applies whether the value is denominated in real currency or a convertible virtual currency. In addition, any exchanger that uses its access to the convertible virtual currency services provided by the administrator to accept and transmit the convertible virtual currency on the behalf of others, including transfers intended to pay a third party for virtual goods and services, is also a money transmitter. FinCEN understands that the exchanger's activities may take one of 2 forms. The first form involves an exchanger acting as a seller of the convertible virtual currency that accepts real currency or its equivalent from a user, the quote purchaser, and transmits the value of that real currency to fund the user's convertible currency account with the administrator. Under FinCEN's regulations, sending quote value that substitutes for currency to another person or to another location constitutes money transmission unless a limitation to or exemption from the definition applies. This circumstance constitutes transmission to another location, namely from the user's account at one location, ergo, the user's real currency account at a bank, to the user's convertible virtual currency account with the administrator. It might be argued that the exchanger is entitled to the exemption from the definition of money transmitter for persons involved in the sale of goods or the provision of services. Under such an argument, one might assert that the exchanger is merely providing the service of connecting the user to the administrator and that the transmission of value is integral to this service. However, this exemption does not apply when the only services being provided are money transmission services, Lightning nodes. The second form involves a de facto sale of convertible virtual currency that is not completely transparent. The exchanger accepts currency or its equivalent from a user and privately credits the user with an appropriate portion of the exchanger's own convertible virtual currency held with the administrator of the repository. The exchanger then transmits that internally credited value to third parties at the user's discretion. This constitutes transmission to another person, namely each third party to which transmissions are made at the user's direction. To the extent that the convertible virtual currency is generally understood as a substitute for real currencies, transmitting the virtual currency at the direction and for the benefit of the user constitutes money transmission on the part of the exchanger. I gotta check something out really quick here. Nice. I just had to check back into something really quick here. And now we are on to C, decentralized virtual currencies. A final type of convertible virtual currency activity involves a decentralized convertible virtual currency, one that has no central repository or single administrator, and number two, that persons may obtain by their own computing or manufacturing effort. A person that creates units of this convertible virtual currency and uses it to purchase real or virtual goods and services is a user of the convertible virtual currency and is not subject to regulation as a money transmitter. By contrast, a person that creates units of convertible virtual currency and sells those units to another person for real currency or its equivalent is engaged in transmission to another location and is a money transmitter. In addition, a person is an exchanger and a money transmitter if the person accepts such decentralized virtual currency from one person and transmits it to another person as part of the acceptance and transfer of currency, funds, or other value that substitutes for currency. See, now that right there explains what I was talking about with regard to, if we just stay as is with regard to mining, you don't need all this money transmitter bullshit. But if we subsect mining into a mining layer and then the witness layer that's going to be these payment channels, now we've damaged that, and one of those people is going to require licensure, and because they do require licensure, they're going to charge for their fucking services. I mean, that's going to inflate the cost of their services, because now they're paying off the government so that they're not acting in non-compliance. Anyway, continuing on. Providers and sellers of prepaid access. A person's acceptance and or transmission of convertible virtual currency cannot be characterized as providing or selling prepaid access because prepaid access is limited to real currencies. Dealers in foreign exchange. A person must exchange the currency of 2 or more countries to be considered a dealer in foreign exchange. Virtual currency does not meet the criteria to be considered, quote, currency under the BSA because it is not legal tender. Therefore, a person who accepts real currency in exchange for virtual currency or vice versa is not a dealer in foreign exchange under FinCEN's regulations. Financial institutions with questions about this guidance or other matters related to compliance with implementing regulations of the BSA may contact FinCEN's regulatory helpline at 1-800-949-2732. And that was it. Relatively short for a government work. I mean, they're usually like stuffed with 10 pages of bullshit. But this is just a loose framework that that FinCEN put out to describe money transmission, and or their definitions of activities that are happening in the cryptosphere. And like I said, I think that as is, we're fine with regard to mining, under regulation. And they say straight out, if you're mining and you spend the coins that you've mined, you're not a money transmitter. So I think that's pretty cool, because that allows you to get the coins into circulation without any additional federal burden. And I think that's exactly what we need, But in any case, I think that this is just like one shoe on one foot, I really think that segregated witness is the other shoe to go on the other foot. Once that one's on, then they'll have their ability to walk in crypto, or walk on crypto, or walk through crypto, or I don't know, step on its neck. I don't know. In any case, I want to go ahead and throw in some music. And I haven't played this much. I've been wanting to play this, or something off of this. And why not? Here we go. 9 Inch Nails, Getting Smaller, here on Coin Metal. And that was Fear Factory with Descent. Little mellower than our average fare here, but I don't want to pound you all down to nothing. Anywho, the next article I'm going to read here, this is the kind of thing that the regulators tell us that we need them to protect us from. That we need their little stamp of approval to stop this kind of thing from happening, or at least stop us from having any negative repercussions from it happening. And this one is on Brave New Coin. 4th largest Bitcoin exchange, BitThumb, hacked for billions of won. This is by Luke Parker, written July 4th, 2017. Bitcoin exchange, South Korea, theft. The largest Bitcoin and Ether exchange in South Korea by volume, BitThumb, was recently hacked. Monetary losses from compromised accounts has started to surface and are quickly reaching into the billions of won. With a reported 75.7% share of the South Korean Bitcoin market volume, BitThumb is one of the 5 largest Bitcoin exchanges in the world and hosts over 13,000 Bitcoins worth of trading volume daily, or roughly 10% of the total global Bitcoin trade. The exchange also hosts the world's largest Ether market. while trade in the South Korean won currently makes up the fourth largest currency market for Bitcoin, trailing the US dollar, Chinese yuan, and Japanese yen. The won market is Ethereum's largest. BitThumb accounts for around 44% of South Korean Ether trading. A cyber attack late last week resulted in the loss of billions of won from customers' accounts. According to a major local newspaper, the Pyongyang Shinmun, one victim who claimed that Bitcoin's worth 10 million won in his account disappeared instantly. A survey of those who lost money from the hack reveals it is estimated that hundreds of millions of won have been withdrawn from accounts of 100 investors. One member claims to have had 1.2 billion won stolen. Oh, shit. Ouch. Hackers succeeded in grabbing the personal information of 31,800 BitThumb website users, including their names, mobile numbers, and email addresses. The exchange claims that this number represents approximately 3% of customers. Wow. The breach was discovered by BitThumb on June 29th and reported to the authorities on June 30th. More than 100 BitThumb customers have since filed a complaint with the National Police Agency's Cybercrime Report Center. While admitting to being hacked on their website, BitThumb maintained that there was no direct access to funds stored on the exchange. Nonetheless, many customers are reporting their digital currency wallets being emptied. The exchange further claims that the breach was made to a personal computer belonging to an employee and not the exchange's internal network, servers, nor digital currency wallets. The employee PC, not the head office server, was hacked. Personal information such as mobile phone and email address of some users were leaked. However, some customers were found to have been stolen from because of the disposable password used in electronic financial transactions. While victim accounts of exactly how their funds were stolen have widely differed, attackers appear to have stolen enough credentials to begin a process of voice phishing where the scammers call up victims one at a time and pose as representatives of BitThumb. One victim claims that the attacker posed as an executive at BitThumb and phoned to say that he was suspicious of a foreign hacking transaction and instructed his victim to give him an identification number written on the letter from BitThumb. The number in question was the victim's one-time password, which granted the attacker immediate access to 10 million won, worth about $8,700 US. The exchange posted a notice on their website stating that, quote, compensation for personal information leakage cases has been decided. The company said they would pay up to 100,000 won per person, currently worth $870 to members. Further damages will be compensated for as soon as the amount is confirmed. They also claimed that they immediately reported the hack to 3 separate agencies: the Korea Communications Commission, the Korea Internet and Security Agency, and the Supreme Prosecutor's Office. However, the Herald reported on Monday that about 100 victims are expected to file a class action lawsuit against BitThumb. It is unclear whether the exchange will be legally responsible for the lost funds. Even after the damages are proven, the situation is complicated by a lack of regulation regarding digital currencies in South Korea, which have not been recognized in any way, which is just fine by me. The Korean Herald reported that a set of bills is being prepared by Representative Park Young-jin of the ruling Democratic Party of Korea. The bill aims to revise the Electronic Financial Transaction Act and give cryptocurrencies a legal standing, including Bitcoin and Ether. A similar process was recently completed in Japan, which legalized Bitcoin payments on April 1st. The amended bills state that only companies with a capital of 500 million won or more, sufficient professional manpower, and computerized equipment are allowed to receive digital currency and handle it. There would also be reporting regulations on anyone earning income from trading digital currencies. San Diego, let's see, is this a new story? Yeah, it's a different story. Well, I don't know. I think South Korea will probably look at the money that they would potentially lose from all the regulation that they're possibly going to put forward and say, you know what, we're small enough that we could really benefit if we hold off just a teeny tiny bit and see how this stuff hashes out in the bigger markets. And I can't say it enough that any kind of big steps that any country makes with regard to trying to regulate cryptocurrencies is only going to hinder innovation where they are and transfer it elsewhere. Like the Isle of Man or someplace else where they really don't have a lot of regulation. But now with regard to regulation, I have to laugh when I hear about people wanting to regulate cryptocurrencies. We've already got plenty of laws against thefts and whatnot, and with regard to BitThumb, investigating that crime should be relatively easy to do. I mean, all of the transactions were most likely done on the blockchain, or at least the funds, if they were moved in Bitcoin, the fucking transactions were traceable that way. And if not, then they were probably traceable via the fiat markets. So, or fiat participants like banks and whatnot. And that being the case, like I said, we've already got plenty of regulatory apparatus that's supposed to, protect us from this bullshit and give us some sort of redress when it happens. But as we've seen, all regulation really seems to do is keep people that are too poor to pay for to pay the regulatory burden to either become criminals or that they just stop doing business, or at least stop doing business in the jurisdiction that's taken it upon themselves to regulate cryptocurrencies. But anyway, the other thing they do is they give a framework for people to commit crimes on. And we see this throughout the quote-unquote legitimate or using FinCEN's terminology, quote, real currency markets, regulated currency markets. We see all kinds of interesting criminal activity being committed. And this one is off of SFGate. We're going to actually jump into standard media for a short period of time here. SFGate, prison sentence upheld for failed SF Bank's chief credit officer. This was written by Bob Eagleco, or Eagleco. Clearly has a penis. 7:52 p.m. Wednesday, July 5th, 2017. Got to assume that Pacific Standard Time, as this is in SFGate. So, here we go. A federal appeals court upheld the securities fraud convictions and prison sentence of more than 8 years Wednesday for former chief credit officer of United Commercial Bank in San Francisco, found guilty of trying to conceal the bank's losses before it collapsed in 2009. However, the Ninth U.S. Circuit Court of Appeals overturned the sentencing judge's order that Abraham Shabuddin reimbursed the government for the nearly $1 billion in payments made by the federal agencies that covered the bank's losses. The court said that Shabuddin's crimes were not the sole cause of the bank's failure. Shabuddin of Moraga was convicted in 2015 of 7 felony charges involving a conspiracy by bank officials to falsify records that would have revealed millions of dollars in losses in 2008 and 2009. United Commercial failed about a year after its parent company, UCBH Holdings, received almost $300 million from the U.S. Treasury's Troubled Asset Relief Program. The program's inspector general later found that UCB executives, while seeking federal help and accumulating overdue loans, had tried to hide the bank's deteriorating financial condition. After the bank failed, the Federal Deposit Insurance Corporation transferred its deposits to East West Bank of Pasadena, which agreed to share the losses with the FDIC. Shabuddin was the bank's chief operating officer in 2008 and 2009 and served from September 2008 until April 2009 as its chief credit officer responsible for credit assessments of the bank's loans. The bank's senior financial officer, Craig On, and a senior vice president, Thomas Yu, pleaded guilty to conspiracy and testified against Shabuddin. In Wednesday's ruling, the appeals court said that U.S. District Judge Jeffrey White may have given jurors a faulty instruction about Shabuddin's responsibility for his co-conspirators' actions, but any such error would not have affected the verdict. The evidence heard by the jury amply supported its finding that Shabuddin was guilty, quote, of each of the fraud charges, the court said. The 3-judge panel also said White's finding that Shabuddin profited from his crimes by $348,000, his salary for that year, supported his 97-month prison sentence and in order to forfeit that amount to the government. But the court said that White's restitution order of $946 million was excessive. There were other cases of the bank's collapse. There were other causes of the bank's collapse, the panel said, including the nationwide economic recession that hit banks hard, as well as some bad real estate loans approved earlier that caused particular harm to UCB. The court told White to try to determine Shabuddin's share of the blame and, if that proves impossible, to consider eliminating the restitution order. Yeah, no, I don't think he should be forgiven. I think he should pay that $984 million. But that's just me. I don't know. I watched that shit unfolding. You know, I watched it from an observer's perspective, but I could see clearly that what was going on was going to create a significant collapse in our economy. And the biggest clue for me was GMAC financing. I mean, these are people that had spent decades financing cars, auto loans, right? And then all of a sudden they started getting into ninja loans. And they expanded previously into housing and whatnot back, I think, in like 2004 or 2005. But they really didn't like get into full swing until like, I want to say like 2006, 2007, where they started expanding into that whole ninja loan bullshit. And I had one of their offices on my route, and they had like 300 to 500 people working the phones doing fucking ninja loans. And I mean, that was such a big red flag for me. I mean, really, dude. It's like, this is not good. Not good. You shouldn't do that. I mean, it was kind of obvious that they were overextending themselves and getting into some business that they really didn't have enough experience in to know better than to do these fucking ninja loans. I mean, when I heard that term, ninja, no income, no job or assets, come on, dude. Why would you give somebody a $250,000 house loan without any of that information? Why would you do it? I mean, clearly the regulations have been tweaked or whatnot in such a way that it gave the bank some sort of discretion that they previously didn't have, and obviously had no ability to properly adjust for. And and here we are. We're still not entirely out of the crisis there. We just shifted the deck chairs around. Gave the banks another short respite of time when they could try and get shit all straightened away. But unfortunately, they spent a lot of that money that they were given to do that with on compensating themselves and rewarding themselves for somehow managing to keep their companies afloat during the crisis. I mean, I don't think that's really that easy, or I'm sorry, that difficult a feat when the federal government is literally throwing hundreds of millions of dollars at you. I mean, I would think that even if you were to take a significant chunk of that money and go to Vegas with it, you probably would have got a better return than just giving it to these bankers. Any case, I wanted to touch on another few points here, and I've opened more tabs, but apparently can't see them from here. I gotta scroll over hard. Anyway, I'm gonna go ahead and kick over to some music for a short period of time while I get this business all straightened out. And with regard to what to play, I haven't played Crowbar in forever. So here we go. A little bit of Crowbar, Like Broken Glass, here on Coin Metal. And that was Slayer with War Ensemble. I know that I have a few fans in the Telegram room, and as much as I would love to go hang out there, I don't like Telegram. And I don't like it because it's asking me for a fucking phone number. And it won't just take a bullshit phone number and just deal with it. No. It wants my phone number. So it can go fuck off. It's a fucking messaging app. It doesn't need to know my fucking phone number. I'm sorry. That's just me. And if you guys feel fine, giving your phone number to it, fine. That's cool. That's you. I mean, I only need to watch so many fucking hacks happen and so many people's personal fucking information get sucked out by one of these fucking apps. Not specifically these apps, but you know what I mean. I only have to see that happen so many times before it's like, I am not willing to subject my personal information to that kind of scrutiny. It's like, you don't need a fucking DNA sample for me to use your fucking messaging app. And if you do, you need to go fuck off. Because fuck you. You're asking me to expose way too much of my personal information just for a fucking messaging app. So, yeah, you can go suck my dick. My apologies. I don't like to get all grumpy like that, but man, you know, it's bad enough with, you know, the fucking NSA trying to spy on you. You got some messaging app that's asking for way more information than they need to be able to provide the fucking service for you. And so it's like, yeah, let me open myself up to another, you know, position where I get fucking nailed like that. That just sounds so fun. Any case, I did want to tap on something else here with regard to law and all that. And where is it here? Oh, jeez. I knew I should have spent a little more time working on this while I was doing the show. Oi. Anyway, I've got a couple articles in my browser here concerning regulated markets, or at least I thought I did. Anyway, that's what it was. I was going to get to Wells Fargo. Because Wells Fargo, they did something relatively recently. I've talked about it on the show before. But, you know, they're one of these big trusted names in banking and whatnot. And over the last, I would say, like 5 years, they've gone particularly scammy. And, let's see here. No, not 24 hours. Let's go to week. Or month. Let's go to month. Anyway, Wells Fargo, they've been doing all this fucking jinky shit. And it appalls me that people are looking at Bitcoin for any reason with regard to regulation and whatnot, when we're finding all kinds of other fucking banking issues and whatnot in regulated fiat markets. I mean, these are people looking over their shoulder, and you know, and they're still fucking up. Let's see here, bank issue, fraud. We'll look up fraud. And fraud. Oh, let's see, wire fraud transaction. No, that's not it. Anyway, the point I was trying to get to with all of this is that there are plenty of fraudulent activities going on in regulated markets. You know, by regulated peoples. You know, so it's just silly to me that they're even looking at us. It's like we're a fly speck on a fly speck of the global economy, and yet we're getting all this scrutiny. We need licenses and shit for doing something that's not much more complicated than global Pokemon trade. I mean, I know some people want to think about it, you know, in a lot higher context than that, but you know, the exchange of items of value digitally kind of fits under the same thing, you know. Anyway, I got an article here about Wells Fargo, and this is I haven't read the article, so I can't tell you whether or not it's going to confirm me or not, but we are going to read it right now and find out. Did Wells Fargo also improperly adjust mortgages among all of their other fraudulent activity? And this is by pymnts.com. I guess this is by the people that run the place, and they don't actually have a name up on here. It was written on June 15th of 2017, or at least posted then. And here we go. As Wells Fargo is trying to turn the corner on a scandal in its consumer banking segment that came to light a little under a year ago, it seems a new set of troubles are coming down the pipeline, this time in relation to the bank's mortgage lending division. Reports in the New York Times indicate officials in the mortgage lending unit were making unauthorized changes to home loans held by customers in bankruptcy. A class action lawsuit for the alleged victims of the loan modifications contends that consumers were surprised to find out their monthly loan payments had gone down, which they didn't mind, and to learn that the terms of their loans had been extended greatly to make those lower payments possible. That they minded. Decades longer on a loan term means much greater interest payments to the bank. Those types of major changes for a consumer in bankruptcy are subject to approval by a bankruptcy court judge. But Wells Fargo seems to have decided to skip that step and just put the changes through without alerting any involved party, according to filings in the ongoing class action lawsuit. The changes are part of a trial loan modification process from Wells Fargo. However, failing to tell borrowers that they were involved in a trial loan modification put them in danger of defaulting on other commitments they've made to the courts. A spokesperson for Wells Fargo, Tim Goida, said the bank strongly denied the claims made in the lawsuits and particularly disputed how the complaints characterized the bank's actions. Wells Fargo contends that the borrowers and the bankruptcy courts were notified. Modifications help customers stay in their homes when they encounter financial challenges, Mr. Goida said, and we have used them to help more than 1 million families since the beginning of 2009. According to court documents, Wells Fargo has been putting through unrequested changes to borrowers' loans since 2015. That's a significant period of time. Yeah. So, on top of terminating accounts for Bitfinex without any real reason and creating fraudulent accounts for 5 million of their customers and then charging them exorbitant fees for transactions done on those, they were also improperly adjusting mortgages, apparently. And this is this is a bank that is, that is supposedly trusted, that for whatever reason they've maintained a significant position in the global market, especially in the banking sector. Any case, let's go ahead and drop back down to some music here. And I'm hearing some Machine Head playing, and that's a band that I very rarely play on this show. Mostly because my Burn My Eyes CD isn't actually here. It disappeared somewhere. I don't know what happened to it. But I'll tell you what, that's one of those albums that you should never loan to anybody. Burn My Eyes by Machine Head. You will never get it back. Consider it a giving. Say, yeah, whatever. Whatever. If you ever get it back to me, great. If you don't. Anyway, I've got a few songs off of The Blackening here. And so I want to go ahead with Beautiful Morning by Machine Head off The Blackening here on Coin Metal. And that was Born in Dissonance by Meshuggah. Oh, man. Yeah, apparently the world of the future is going to slowly cancel me out. It seems. Trying to sign into this fucking Telegram shit. And you need a smartphone in order to fucking sign up with it, because apparently, or I'm doing something wrong, which is entirely possible. I tend to be the pebcac. At least I recognize that about myself. A lot of people just kind of float through until they run into something they can't figure out, and then I have to come out and fix it for them. Anywho, I wanted to touch on this one article because I've been thinking about Ripple and their function with banks. I think that Ripple was more or less designed for banks. And I saw this article on Bitcoin News, and I gotta read it. Ripple to benefit from banks cutting correspondent relationships. And I gotta get out of this fucking weird shit that's playing in the background. There we go. That's better. Anyway, there are quite a few interesting trends in the banking sector to make note of. One particular trend indicates how some banks are axing correspondent banking relationships. It appears this is a growing trend as we speak. This also means banks want to rely on others less often, which can herald a grand era for new solutions. Ripple, for example, can benefit quite a bit from these correspondent relationships going awry. It is... you know what? God damn it. Fucking Bitcoin News. They reposted somebody else's article. And they give you about two fucking paragraphs of it, and then you have to find out where else it's published. And this one is on livebitcoinnews.com, apparently. And, Ripple to benefit from banks cutting corresponding relationships. Alright. It's not entirely surprising risk-averse banks are making some drastic changes. And that's a link right there. Let's click on that. Cutting relationships with other institutions, potentially violating AML and KYC rules, is the best course of action. In the cryptocurrency world, issues like these caused a fair bit of issues for Tether and Bitfinex not too long ago. However, this strategy will severely impact the financial sector in developing and poor countries. Globally active correspondent banking relationships have dropped by 6% since 2011. Correspondent banking relationships are too risky. This number only grows larger where USD and Euro relationships are concerned. It is a big concern for all affected regions that much is evident. Reducing the ability to send and receive international payments is not a positive development. Some form of a solution will need to be created to solve this issue. It opens the door for projects such as Ripple to take its rightful place in this sector. While it is understandable bankers are concerned over U.S. regulators, cutting relationships is not necessarily the best idea. Directly partnering with other banks is no longer an advisable course of action. Using an interledger system of participating banks is an option well worth considering. Ripple has made this technology available to all banks around the world. Various trials of this technology are taking place mainly in Asia. It is only a matter of time until we see more of these projects in Europe and in the US. The banking sector is undergoing major changes behind the scenes. The traditional way of sending and receiving international payments is slowly coming to an end. It is time for institutions to focus on blockchain technology and make an impact that way. Whether or not they will embrace Ripple remains to be seen. The company is the leading blockchain provider for the financial sector, though. The future is looking quite interesting for Ripple and blockchain technology, to say the least. And that is just a jerk-off article. Sorry. Yeah, I really see banks in a different perspective. I mean, they could use Ripple as the mediating, the underlying mediating protocol they use, right? And it more or less functions pretty much like they do. And how they would need to function in the event that they were to recast themselves in their previous role in the financial relationship between the person and the greater global market. See, I think that because travel and digital things have made the necessity to be at any one place at any one time to be kind of archaic. You know, I mean, literally, if I have access to the internet, if I have a digital device, I can enjoy the same level of access to my digital lifestyle as I could from my desktop at home. Now, why we have laws that specifically go to inhibit this action is simply beyond me, you know? Like these requirements to have, you know, a physical address just to have a cryptocurrency exchange account. I think that's fucking ridiculous. I mean, we're talking about an action that happens entirely in a digital realm. Why is there some necessity to associate it beyond me individually? You know, I mean, if you have my personal information, like the bank account that I've got, or, you know, the routing number for the bank account, my credit card number, my physical address, so as it may be, a phone number, all of these things, you know, why above all of that am I required virtually to have a physical address that I'm owning or renting from somebody else in order to participate in these processes? I mean, there's more than enough ways for them to detect exactly where on planet Earth I am or where I'm broadcasting from. They can fucking triangulate that just by the hops that my packets are making on the fucking networks. And of course you can spoof that stuff to some extent. But if I'm an honest actor, I'm probably not doing anything to hide my physical location. In which case, you know, what do you need to know beyond that to be able to do business with me in a digital realm? Nothing. You just have to know that it's actually me. And I'm sure there are other ways of proving it than, you know, me giving you my fucking driver's license number and, again, my physical address. I think it's just fucking ludicrous. But, you know, we're still living in a world where physical proximity really means something to a lot of people. And aside from, you know, wanting to interact personally with people, I don't really see that it's a necessity. You know, I mean, you can certainly interact with people via Skype or, of course, Telegram or a million other fucking mediums of communication. You got IRC, you got Twitter, you got Facebook. The methods of connecting to one another are only growing in number over time. So yeah, I think that moving money around, so much of it's already being digital that making efforts to inhibit that, I see these as actions against the future, and blind actions at that. That there's no real thought going into it. No real thought about what the overarching, effects will be on the global economy, other than it's going to keep your buddies in their current position for a short period longer. Until the future just catches up to you and runs you over with a Mack truck. Anyway, I got another article here, and this one is touching on our previous theme here of, why the fuck are you looking at us when there's so much of this shit going on? Anyway, and this one's on Bloomberg. Ex-Barclays executives bank to appear in court on Qatar charges. And this is written by Susie Ring. I'm assuming no penis. July 2nd, 2017, 11:10 p.m. PDT, whatever PDT is. Barclays plc and 4 former executives will appear in a London court for the first time Monday to face allegations they conspired to commit fraud over a 2008 bank capital raising with Qatari investors at the height of the financial crisis. Former Chief Executive Officer John Varley, former Chairman of Investment Banking for the Middle East, Roger Jenkins, for the Middle East. Dude, put a fucking period in here. Roger Jenkins, ex-wealth chief, Thomas Kalaris, and Richard Both, former European head of the bank's financial institutions group, will appear alongside the bank at Westminster's Magistrate Court. The hearing, which will discuss bail terms and future court dates, is the first time the group will be seen in public together since the charges were filed in June. The men were the most senior UK banking executives to face criminal action since the financial crisis, which sent banks scrambling to raise the funds to cover billions in losses. The Serious Fraud Office case relates to £322 million, $418 million, in fees Barclays paid to the Qatar Investment Authority and a $3 billion loan facility it made available to the nation as part of side deals to the £12 billion fundraising from the Qataris and others. The bank, Varley, and Jenkins each faced 3 counts of conspiracy to commit fraud by false representation and unlawful financial assistance between May and November 2008 in relation to the British lender's June and October fundraisings. Boeth and Kalaris, who is an American, each faced 1 fraud count between May and August over the June capital raising, according to the court listing. All except Jenkins, who is based in Malibu, live in the UK. Bail terms are assessed on factors including flight risk, consideration of residency and means, which can lead to 6 or 7 figure securities being posted in these types of cases. A London judge released former Deutsche Bank employee Christian Batar, who lives in Singapore and is charged with rigging a key interest rate benchmark on $1 million bail last year. Barclays' case should be sent to a higher criminal court following bail arrangements. No bail! No bail at all. Those people deserve no bail. They deserve immediate prosecution. Man. Come on now. How many people did they rip off in that scam? But I mean, here we're talking about people that are in regulated markets, and they're getting away with this shit for years. So what good is the regulator if they're not catching this shit while it's happening? Not, after somebody tries to withdraw their money and finds out that they got a big zero in their fucking bank account. I mean, something should happen like way before then, if all of this regulation is actually worth it. I mean, I'm not saying that we need some sort of totalitarian state, but I mean, really, if these people actually have to get licensure and whatnot, what does the licensure actually pay for? The funds that are collected for licenses and whatnot, what does that pay for? If it's not going to preemptive detection or investigations or audits or shit like that, what the fuck is it going to? I mean, is it just paying people to issue licenses, or what the fuck? I mean, especially if we're talking about markets that have global span. In one way or another, there are assets or commodities or whatnot that are tied up in these deals, and bank accounts and fucking monies that are tied up in these deals that span the entire fucking planet. And so when there's some screw up in them because of abuse of the trust model by the underlying bank and the employees thereof, I mean, that's just a vile violation of trust. And really, when I talk about cryptocurrencies being a response, that's one of the things that they're a response to, is the absent-minded, greed-driven abuse of people's trust. We have these certifications and these licenses for a reason. And it's not just to give you the rule book so you figure out how to fucking continue your fraud while technically following the rules. And sometimes I have a hard time differentiating that from, people acting fraudulently within the cryptosphere. But you got to draw the line somewhere. I mean, if you're going to be taking up these custodial responsibilities and you're going to pay for these fucking licenses, that means that you're fucking culpable when your people abuse the trust of your customers. I mean, that's what that shit's supposed to mean. It's not supposed to mean that, you get a slap on the wrist and you can still turn the signs over that say you're open in the morning. That shit needs to end. I mean, if you're going to have a regulatory body, fuck, man, I want you to prosecute motherfuckers, and I don't give a fuck if they're your nephew or they're the son of your former employer or whatever. That relationship is over. When you take the one hat off and you put another hat on, that relationship is over, or at least it should be. And your former employer, or relatives thereof, should enjoy no deference in the eyes of your new office, especially if it's a federal one. It's one of the reasons why we're not seeing a lot of call for blockchain in official capacities, I think. Only because there's so much fucking fraud, waste, and abuse. They would catch that shit in a heartbeat, and a lot of people would be unemployed in DC, like, the next day. It'd be like they turn the on switch and find out that half of the offices are operating fraudulently, and be like, all right, you're all out, and now what? There goes your control structure for this shit, and and you got a lot of people in jail who actually should be in jail as opposed to non-violent drug offenders. any case, I want to close this one up with a little bit of good news, bad news, I guess. I mean, I consider the quote legalization of Bitcoin to be just as bad as the quote regulation of it, because they're kind of hand in hand. Anyway, this one is by Joseph Young. It's on Cointelegraph. It's official. Japan has eliminated tax on Bitcoin. Rise in trading expected. Yes, I would most certainly expect that to happen. And this was apparently authored 15 minutes ago, although it could be 15 minutes from the time I actually clicked on this originally. So I'm just going to reload this. Yeah, it was on July 3rd, 2017. Anyway, let's go ahead and dive in. Japan's tax reform bill, which officially eliminated consumption tax on the sale of Bitcoin, came into effect on July 1st. Bitcoin trading activities are expected to rise in Japan following the activation of the bill. In a report entitled Japan, Inbound Tax Alert 2017 Tax Reform Proposals, Deloitte previously revealed that virtual currencies, including Bitcoin, were set to be exempt from the 8% consumption tax in Japan. Deloitte's report read, "The supply of virtual currency will be exempt from Japanese consumption tax, JCT. Currently, virtual currencies such as Bitcoin do not fall under the category of exempt sales, and as a result, the sale of virtual currencies in Japan have been treated as taxable for JCT purposes." Following the enactment of the amended fund settlement law in May 2016, which newly defined, quote, virtual currency as a means of settlement, the sale of virtual currency is defined under the new fund settlement law will be exempt from JCT. This change will apply to sales/purchase transactions performed in Japan on or after July 1st, 2017. Japanese Bitcoin market. On March 27th, the Japanese National Diet officially approved the 2000 tax reform proposals shared by Deloitte, passing the Bitcoin consumption tax bill along with other bills listed on the proposed reforms. The bill, which came into effect on July 1st, is expected to drastically increase Bitcoin and cryptocurrency trading activities within the Japanese cryptocurrency exchange market. On April 1st, the Japanese government officially recognized Bitcoin as a legal payment method and currency. Since then, the Japanese government has been focusing on creating and establishing a more efficient ecosystem for Bitcoin traders, businesses, and users. A major part of the initiative was to render Bitcoin and cryptocurrency trading frictionless, allowing traders to easily access cryptocurrencies without having to deal with external factors such as taxes. Bravo, Japan! The Japanese Bitcoin exchange market is already well regulated and well equipped with appropriate Know Your Customer and anti-money laundering systems. AML policies are especially strict in Japan and South Korea. It is difficult for traders to take advantage of potential arbitrage opportunities and utilize Bitcoin to move large sums of money outside of Japan without triggering the AML systems adopted by local trading platforms. Bitcoin price increases? A coincidence? Although it could be completely coincidental, since the activation of the Japanese Bitcoin tax elimination bill on July 1st, Bitcoin's price increased from $2,450 to $2,570, it is not a fair assessment to wholly attribute Bitcoin's upward momentum to the Japanese market, as it only accounts for 16.2% of the global Bitcoin exchange market. However, positive signs for Bitcoin trading in Japan could have established a positive precedent across Asia, which controls more than 65% of the global Bitcoin exchange market share and affected Bitcoin price. The Bitcoin tax elimination bill is also important for the ecosystem of Japanese Bitcoin merchants. Recently, some of Japan's most influential companies, including its largest electronics retailer, BitCamera, started to accept Bitcoin as a digital currency and a payment method. Soon, hundreds of thousands of restaurants, cafes, and stores could begin accepting Bitcoin as AirRegi, Japan's largest point-of-sale machine operator, is looking to integrate Bitcoin by the fall of 2017. Excellent, excellent, excellent. Now, here we go. This is a countervailing shot fired with regard to regulation of Bitcoin and cryptocurrencies. I know some people won't see it as that, but that's pretty much what it is. You know, when we're talking about Japan, we're talking about a major financial powerhouse. They move money around, a lot of money. And that being the case, any move that they make like this, it's definitely going to disrupt the pond, so to speak. In any case, I want to go ahead and close out this episode. We will be back again on Friday at 8 p.m. Pacific Standard Time. And until then, I want you all to trade safe. I want you to do your homework, because you never know. You might be in violation of a law with your whiz-bang idea of how to do a specific thing in cryptocurrencies. And most certainly watch out for your own bunghole, because there's some law out there that may in fact make you illegal, and that could be bad. Most certainly. In any case, I want to close it out with a little bit of prong if I can find it on here, because I do play it a lot. And something off of No Absolutes, we're going to go with No Absolutes. Thank you very much for listening, and you all have an excellent evening.